Hello, it's Richard C. Wilson at the Family Office Club, and I'm excited to have Jeffrey with me here today. Hi, Jeffrey.
Hey, how you doing?
Great, thanks for being here. So what type of investment firm are you with?
I'm the CFO of, and I'm the CFO of the SPAC that they sponsor.
Okay, great. And I know what a SPAC is. I've had a couple other interviews like this with SPACs recently, but many people are not familiar. They don't know whether it's a tiny market, a huge market, if this is a new concept, an old one. Can you just comment on exactly what it is and how large that market size is?
Sure. So a SPAC basically starts out with the sponsor. They're the at-risk capital. They pay all the fees for underwriting, legal, and et cetera. And they have the at-risk capital. They sponsor a company that has an IPO. The IPO is designed to bring in the investors into the SPAC. So they're the shareholders. It's typically on NASDAQ. They'll raise between 75 million and a couple of $1 billion. So it's a pretty wide range. Year to date, IPOs for SPACs has been about 13 million. That's the same as the whole year 2019, and it's expected to increase to maybe 25 to 30 billion dollars this year. So it's a significant part of the IPO market. The way it works really quickly is if you're a shareholder in the SPAC, you get one share, typically for $10, then you get a warrant. And the warrant is exercisable usually at about $11.50. And where it makes an attractive investment is that as a shareholder, all your money goes into a trust. So it can't be touched by the sponsor when the sponsor is looking for an investment for you. At the end of the merger, you'll have a proxy, and you could vote if you want to put your shares in trust into the new company, or you get your money back with interest. So it's a interest-bearing, risk-free investment for the shareholder. It's almost like going into private equity, but you have a choice of doing the deal or not. For the sponsor, there's risk because you have all the at-risk capital. So you're paying for underwriting, legal, due diligence, all the SEC reporting, and all the legal expenses. So that's the at-risk capital, and obviously the sponsor has a promote at the end.
Okay. If somebody raises like $150 million SPAC, and there's a deal getting done, and let's say 50 million of the investors don't want to go in, can the deal still go forward if they have enough capital from the 100 million, or does it need to be a majority vote and then you're in if it's a majority vote, or can single investors come in or out based on their vote?
A single investor can redeem their shares. Typically, what they'll do is they'll have a backup source of capital, either additional investors or a PIPE, or they just get a smaller percentage of the company, of the merged company. For the company that's the target company, it's very attractive also because they get to go public and they're not going through it, which is a big advantage. They do need to have PCAOB audits, so they do have a little pain and expense.
Sure.
And they have their own expenses, but it's very advantageous for the company because then they could do some estate planning. They don't have to sell the company all at once, and they can retain the control of it. So there's benefits for everybody along the way, and I think that's also why it's become a very popular tool now for the market.
Yeah, that's great. Okay. And what is your SPAC specifically focused on, scope, like geography-wise, industry-wise, size of the deal-wise?
Well, our SPAC has already announced a LOI in the public market, so we're already working towards closing that deal. Schultz Asset Management has been around for 20 years. They deal mostly in distress and reorganizations. But we have a pretty broad mandate on our SPAC where we can look at any good deal that's going to bring really good value. We looked at a lot of different deals in a lot of industries. We just looked for hopefully something that would be aligned with our history, but this time it was not a distressed deal. It was just a great company, what we felt was a great future. And when we signed the BCA agreement, there'll be more information in the public market about that. We were focused on North America primarily.
Okay.
And the important thing is,
Go ahead.
what we were looking for was a great management team, because the SPAC only buys a percentage of the company. And it's typically, it doesn't have to be a majority share. So you really want to partner with a great management team. And that obviously takes a lot of time for due diligence and meetings and et cetera.
Sure. Makes sense. And in my experience, somebody like yourself as a CFO or your CEO, your head of deal origination, you'll come obviously from different types of backgrounds, maybe at a $20 billion private equity fund or a large bank or investment bank. And typically you have your favorite industries, even if you are open to all ideas or looking at mostly distressed stuff. So in your case, what's the number one most favored industry or type of company that if you could, you would rather spend half or 80% of your time looking at just that one niche so that people in our investor club could, help bring those types of deals to you?
We look for great companies. We're agnostic, to be honest. What we want is a company that has a great name in their industry and has a lot of growth potential. They might have gone through some hard times, or they might have a vision and that they're ready to go public. It's not about the industry. It's about where they are and where they are in their market or in their industry, and what our view of that industry is. So
okay, makes sense. Okay, and last point: what's the number one piece of investment advice or insight that you have as it relates to SPACs or just your experience in investments that maybe you wish you knew a decade ago that you could share with our audience?
It's like anything else. You invest in people. You have to be very comfortable with the people who are leading your team, the investment, their track record. And that's the number one thing I tell people. If they're looking at hedge funds, private equity funds, family, small startups, how long have they been in business? What have they done? And how much, and what have their returns been? So it's all about the people, not exactly the industry. And that's the one thing I've learned. I've been doing this for 30-something years, Merrill Lynch, Salomon Brothers, et cetera. And you invest in people.
Right. Yeah, well, that's it's something that's been reinforced through doing 80 of these investor interviews. It's the most common thing that people say, but oftentimes I think people miss that when they get excited about a new concept or a new trend or some new exciting opportunity. The opportunity could be amazing, but with the wrong team, it doesn't mean anything.
Right.
It could be a bad idea, right? So, yeah, appreciate you. Yeah, go ahead.
It could all be lined up, but if you don't have the people to make it happen, it's not going to happen.
Right, for sure. Okay, great. Well, appreciate you being here. I'd be happy to have you on one of our virtual investor discussion panels in the future. We're having those each week and doing some virtual conferences as well. You obviously have a lot of expertise in this area, so I appreciate you taking the time to share your thoughts here today, and we'll keep in touch.
Okay, thank you very much.
Thank you, Jeffrey. Take care.